Greetings, all of us. Welcome to the CDSE webinar series. We usually hold these webinars on a monthly basis, talking about different market events. And today we are delighted to be talking about the Safaricom full year 2025 performance review, as well as the banking sector Q1 highlights, at least what has been announced. Now, as we wait for folks to trickle in, I want us to start in like a minute or so, but you can, in the meantime, learn some insights, especially about how you can access the stock market through the market application called Dosika. So enjoy. It will just be probably a minute, and then we can get started.
Are you looking to start investing in the Kenyan stock market? We have just the solution for you. Introducing Dosika, a mobile app that is designed to make the Kenyan capital markets accessible to everyone with a simple-to-use interface. The app provides real-time updates on stock prices and news, which is crucial for investors. Here's how to sign up. Download and install the Dosika app from the Google Play Store. Create a Dosika account by signing up with your email address and phone number. Once you've signed in and linked your account, you are all set to start adding securities to your watch list or portfolio. To track the performance of your portfolio, go to the Portfolio tab and view your holdings. Dosika ni investment chap mkononi. Dosika, grow your wealth.
This is Jane, and this is Julia. They went to the same school, got jobs almost at the same time, and are learning the same amount of money. Their dream is to invest in real estate as soon as possible, and of course, buy a car. Jane has been consistently saving with the bank. On the other hand, Julia researched and found out investing in the stock market as the best option for her. Over the same period of time, she has finally managed to get a deposit to buy her first car. With the Dosika app, you can trade from the comfort of your home. No paperwork, more options, no hustle. Download the Dosika app today.
Yes, thank you. I think we have the numbers. The rest will join us as we proceed. As you've seen in the Dosika video, we sometimes get this question. People sometimes assume that shares are only to be bought, are only bought and sold, are only bought and kept for dividends, but you can also buy and sell it at a higher price and do whatever it is that you have planned for. So you can also use the capital markets to achieve your financial goals, whether it's to retire early, whether it's to give your children something to kickstart their journey in life. All that can be done through the stock market, and especially if you work with a good financial advisor. And one of them here is Pergamon Investment Bank. So for those of us who might not fully know what we do at the CDSE, we are the depository, the main depository for equities, which is the shares and also corporate bonds. And our main role is to ensure that when you buy or sell securities, those securities are held in safe custody in the central depository system. That's why if you own a shares account, if you own shares, you have what we call a CDS account. If you don't, probably through your parents who have still certificates, we encourage all of them to immobilize those securities because they can't trade when they are in certificate format. And CDSE through the CDS account is now electronic proof of shareholding. We also ensure that the settlement of shares happens efficiently, and that is the we call them the post-trade activities. When you trade on the securities exchange, it is not the NSE that facilitates that settlement, clearing and settlement. It is us who ensure that the money moves to the people who have sold and the shares move to the people who have bought. We also do other things like ensuring that you can use your shares as security for loans. You can also transfer your shares to your children, to your especially in your immediate family. You can transfer those shares, and this is actually a service that we offer through the stockbrokers. You can also, in case of demise of your loved ones, we also facilitate the transfer of those shares. And of course, the main product or the main way to access the stock market is through account opening, our CDS account, which I've shown you in the Dosika application. But we shall also talk about the Dosika application if we'll have time. But I'll also share, for those of you who have not interacted with the Dosika app, and if you don't know, that's now our main app that you're using. If you're using Rhino app, we are no longer using. We stopped the supporting Rhino app. We are now using Dosika, so you can interact with that platform, because more things are coming, especially in terms of how we shall be deploying our services. But enough about me. My name is Stevie. Enough about CDSC. Let's talk about me and why, and also why we are here. My name is Stevie Natema. I work with the Central Depository and Settlement Corporation in the strategy, commercial, and research functions. And part of why I'm here is that we are supposed to also not only share the story of the capital markets, but also help you understand what CDSC does and share our story and interact with you to see how we can serve you better. But today I have a very special guest. He works with one of our central depository agents. You call them stockbrokers, and for this one is actually an investment bank. And I just let him do the introduction for who he is, what he does, and then we can get started. Shadrack.
Thank you, Stephen. Good evening, everyone. Welcome to this presentation on investment. I'm Shadrack Manyinsa, a research analyst for Pergamon Investment Bank, and it's a journey that we like to start with everyone. So I welcome everyone. At Pergamon, we are an investment bank licensed by CMA, and also, of course, an agent, a CDA agent for CDSC. So we do a number of things. Maybe I can show you on what we do. Allow me to. So we are Pergamon Investment Bank. Our main functions are especially in terms of investment, where we have a range of products. We offer advisories, we offer brokerage services, we do offer institutional dealing, that is especially for corporates, but also we are going also in terms of the retail side. We offer corporate finance, which is majorly corporates who might need maybe capital raising, maybe to go IPOs, that is listing, and others. So we offer research and also private wealth management services. That is who we are. I'll maybe at the end of the presentation, I leave you our addresses and also how you can reach us. Thank you. Thank you, Stephen. You're on mute, Steve.
My word, I thought we were done with this this thing of speaking on mute. Sorry. I was saying thank you for that presentation, and for anyone who is looking to get a stockbroker or an investment bank, especially if you are capital raising or you are just looking to get advice on how to get started in the stock market, I believe Shadrack and his team are very able to do that. Before we get started, I don't know, Shadrack, if you've ever considered or thought about what you would be doing if you're not an investment analyst. If you didn't have to work for Pergamon, what would you be doing?
Definitely, I'm passionate about data analysis, about data. So probably I will have been doing something related with probably data, especially maybe not of course in the investment bank, but other avenues of investment, and also including farming is also quite good. But then I've come to realize that investment in the capital markets has quite higher returns. You can get as high, we saw last year, very high returns going up to around 18%. That is, you just relax and get that. That is, which is like a passive income, which you don't have to struggle about it. So I'm passionate about investment actually.
So if you didn't have to work for Pergamon, you'd be a farmer, and maybe doing some data analysis for maybe the entire market. I also noticed that a lot of research analysts also pivot towards being economic analysts, and so I guess it's also something that comes with the job. If I didn't have to work at CDSC and do these webinars, I'll probably be doing a podcast about things that I'm interested. Maybe for the sake of my employment, I'll not share what I'm interested in, but I would be doing a podcast, probably still touching a bit on investments, but just having conversations with people. I like having conversations with people because it's through the conversation that you really learn people and get to hear their stories. Okay, so let's not bore our audience with our wishes. Let's get into why they came here. And please, if you could share your presentation. Your presentation is actually on. If you could turn off your camera and then just take us through the presentation for the next probably 30 minutes, and then we can come back to the Q&A. Thank you.
Thank you, Steve. I hope I'm audible enough. Kindly confirm.
Yes, you're good.
Good. So in this presentation, we shall look at specifically 3 parts. We have about the economic, what is happening in the local economy, maybe in the global side, and also the local economic performance. So generally, the Kenyan economy is is a bit coming out of some stress. So we expect some rebound, especially in this year. We saw last year the economy record a 4.7 growth, which was quite a lower growth compared to what was there in 2023. But then that, of course, there are so many headwinds in terms of the economy, how it has performed, ranging from high interest rates, then coming to, of course, the cost of living rising up, then, of course, so many others, which include, of course, a constant campaigning period. So many. And then, of course, we saw in terms of currency and stability, but then so far that has cooled down. So we expect the economy, at least for this year, to move up around 5% to 5.6%. That is for 2025 and also 2026. And part of this will be the reason what will drive this. We expect the private sector to move the economy much more compared to any other. Remember, the private sector contributes about 55% of the GDP growth for the country. So we expect, because of that, the interest rates are coming down. We expect those that to drive credit in the market, or rather borrowing, to increase purchasing power, and also the borrowing power in the market. So that is expected to improve the economy. Although a number of things, looking at the finance bill, looking at the high debt levels, looking at tax corrections, which is quite below target at around 1.8 trillion as at last month. That is 10 months of the financial year 2024-2025. So there are many, of course, the headwinds are like overweigh what are the drivers of the economy, but then we remain positive about the economy developing or rather growing. So the banking side, where I will focus hereafter, we have seen disbursements are somehow improving, which had contracted actually last year. We saw last year disbursement contract because of higher lending rates. We had rates going as high, some banks lending above 20%, of course, which was heavily high compared to what it was maybe in the last 3 years, where the interest rates was around a stable, they stabilized at around 13%. So because of that, there was a contraction in terms of overall loan book of the banking sector, and that one had an impact on the economy, which saw the GDP growth slow down from, of course, that 5.7 to 4.7%. So, and then we expect also the shilling to remain stable, which will, of course, help in terms of predictability of the market. Many investors or other businesses will be able to predict exchange rate and, of course, be able to plan ahead. And then now we have seen rates come down where they were at around, I say that from 20 to currently at around 13%. That is in the treasury bill and the treasury bond market. That is government securities side. But then, of course, in the commercial banking lending, they are around 15% to around 15 to 17%, which is quite somehow a reduction of around 2 to 3% from where they were last year. So we shall look straight away to Safaricom, and then thereafter we shall look at the banking sector, how it has performed. On Safaricom side, we have seen the local unit perform quite very well actually, reporting a very good profit in terms of BBT and also in terms of BAT. But then what a challenge, of course, came from Ethiopia. Remember, Safaricom entered Ethiopia in 2022. So this is the third year of their operation in Ethiopia. And then because of that, there was, of course, that edge into the profitability of the local unit, which saw group profit report around 93 billion for the year ending March 2025. So, but then for this year, it's expected, or rather, we project a growth in terms of the BBT for Safaricom, which is expected to be around roughly above 105 billion. That is from profit before tax. That will be an improvement. But then, of course, the company itself gives some good projections, which is around, let's say, above 130 billion in terms of profits before tax. So now, for Ethiopia, Safaricom Ethiopia, it's projected that the break-even will still happen in 2027. Remember, that was a review from 2026 area projected in around 2023. And yeah, in 2023, where the projections had indicated the break-even to happen in 2026 March. But then there was an update where Ethiopia had some challenges in terms of liquidity. And then that impacted, they had to call, of course, the external financing, which came in through IMF. And then the IMF came, of course, in Ethiopia with its regulations, which is so actually the currency depreciate heavily. And part of those reforms were to leave the currency to the market forces in terms of the exchange rate. That saw the exchange rate against the USD move from around 50 Ethiopian bills to almost around 130, currently trading at 130. So because of that, we saw revisions of Safaricom Ethiopia break-even, which we had projected to be a game changer in terms of the prices. Remember when Safaricom entered Ethiopia in 2022, we saw the price hit around 40 shillings per share, actually around 44 shillings per share. But then we expect now, the projections are as from 2026 March, when we expect of course, around May next year, that is 1 year from now, when they announce their financials for the year 2026, we expect an upsurge in terms of depending on how the performance will be, it will inform where the direction will rally towards. So until then, we expect somehow the price to remain around in levels of around, let's say, between 19 shillings and 26 shillings. Our valuation actually indicates at around 26 shillings per share. And that is largely on Ethiopia projections and also what in terms of local performance. Now, on how they performed, you can see there, the mobile, that is M-Pesa revenue, remains a game changer for Safaricom. That is recording a growth of around 15%, 15.1% last year, which was quite very good, an impressive one. That is around 21 billion addition from 140 to 161. And part of this was majorly because of business payments. Lipa na M-Pesa, or rather, payments through M-Pesa remain to gain traction across the economy, especially locally. So that one will continue to drive revenues for Safaricom, even way beyond, even for Ethiopia actually. And from what they project, Ethiopia is going to replicate what's happening locally. And then, of course, they have rolled out M-Pesa in Ethiopia, which has seen actually some good acceptance and reception. We saw in terms of growth, in terms of that is customer subscriptions for Ethiopia, they doubled actually. So that can inform you that, of course, as much as Ethiopia might be, somehow the usage might, or rather, usage of techno might be, that is the technology, they might be behind somehow compared to Kenya in terms of digital or rather being digital. But then you can see the long-term outlook is a very good for Safaricom. So Safaricom also, in terms of now from the net income, which was around 45 billion, this was muchly hit because of Safaricom Ethiopia, which recorded a very almost like around 49 billion loss. That was a rise from around, okay, I didn't indicate that one here, but it's a loss from around 40 billion recorded last year in the year 2024. That is from 40 billion to 49 billion. So that one hit onto the profitability of Kenya. But then you can exclude now, if you can remove Safaricom Ethiopia and see how the performance is, Safaricom remains the best performing company among, followed by some banks, which we shall discuss. So as of March 2025, Safaricom recorded 103 growth in terms of Safaricom Ethiopia subscriptions up to 8.8 million subscribers. Out of these, those active are only 7.1 million. But then so far, in terms of coverage, they have covered over 50% of the population, which is at around, they have set up almost over 3,000 satellites across that country. You can see I'm focusing on Ethiopia. One of the reasons for this is because Ethiopia has, of course, a very high population of around over 115 million. And even if they get even 40% of the population, that is a game changer, because looking at locally, Safaricom has a subscription of around 36 million subscribers. So if we can give that revenue to Safaricom, then look at what 40% in Ethiopia can do, or even 30% can do. So in terms of valuation, I did using 3 methods purely. That is enterprise value method, and then of course there are multiple, and the dividend payment model. You realize that Safaricom, in terms of dividend payment, it has remained stable for the last 3 years. They have paid around 1.2 shillings per share, actually 1.2 shillings per share, and that is quite low compared to the dividend payout. And part of the reasons why we retain a buy recommendation on Safaricom is because of that. The dividend, we expect a dividend review. In the last briefing, of course, there were some questions where there was the management alluded that they are likely to increase that dividend to be aligned to the company payout ratios. That is the company policy in terms of how much they are able to pay from their earnings. That is all for Safaricom. So I want us to look at the banking sector, how they have performed in the last 3 months of the year 2025. So in this, majorly, the challenges in the banking sector remain high NPLs, that is high non-performing loans, and then of course that ate into, of course, higher rates, high lending rates. So of course disbursements reduce, but then also that also saw some investors, or rather some clients, shy off from, of course, borrowing, which is because of course, expensive borrowing. And then of course, those two challenges, around three challenges, but then the banking sector remained quite stable with very good ratios in terms of liquidity and also capital ratios. Actually, all the listed banks remain within the levels required by law. And then now we shall look at roughly 9 banks at the time of writing this presentation, we had around 8 banks which had reported, but then we had, of course, Equity coming late, which is reported today, and then we had also DTB. We excluded DTB from this, but then maybe in future presentations, we can also have it on being reported. So from this, KCB remained the most profitable bank, reporting a profit before tax of 21 billion. And out of this, among the 9 banks, there's only some few, around 5 banks, which recorded growth in terms of interest income. And the reason for that, from last year August to February April this year, we saw central bank reduce interest rates. That is the central bank lending rate, reducing all the way from 13% to currently 10%. So the reason for that, of course, is to push credit to the economy. And because of that, we have seen, of course, as I said earlier, interest rates come down across all the listed banks, across all the banks. And that one has already been priced in terms of Q1 results, which has seen most of the interest income for major banks, or rather for all the listed banks. Most of it either remain stable or record some minimal or marginal growth on interest income. And then that one had also an impact on interest expense across the industry, where in terms of how much banks used to finance their loan book, the interest expense went down at a very fast rate compared to how, of course, the rates overall, the market rates came down. And the reason for that, of course, is banks had to price in to their deposits. That is both customer deposits and also deposits from maybe other banks and some other corporates. So as a result of that, interest expense reduced very fast at a faster rate, which of course led to an increase in terms of the net interest income. Net interest income is, of course, what we get from interest income minus interest expense. What you get minus how much you use it to finance that loan book, or rather how much you use it to finance the securities book, if it's a government securities book. And then, as you can see, there was also, these are on the presentation, we have only 5 there, but then we have others in the second slide, the third slide, which follows. So, but then if you can look at non-performing, non-funded income, which is non-interest income, there was a reduction across all the banks, actually, all of them recording declines. Like now, if you can see, for instance, KCB and Equity Group, they recorded declines on that line. And why was that so? The reason for this was majorly because of the currency stability. Compared to last year, between January and March, we had this year the currency remained stable at around roughly 129 shillings. That is around 129 shillings 0.2 per US dollar. And that one had an impact on forex trading income. Forex trading income is the major contribution in terms of interest. It comes the second contribution after commissions on loans and advances. So that line also, of course, it contributes about roughly around 40% of the non-funded income. So because of that reduction, it impacted all the non-funded income across the industry. So, but then maybe from next year, we can see where it will stabilize, because as for the rest of the year, we expect Q2, Q3, and of course the last quarter of the year to have a minimal impact, considering that between January and March 2024, we had currency move, that is Kenya shilling exchange, move from around, when you compare it to against the dollar, US dollar, it moved from around 140 to around 159 there. But then, as from April, that is towards end of March 2024, up to now, up to almost end of the year, we saw at least some small declines, which was from around 140 shillings, from 140 up to the level where it stabilized between towards August there. That is where we saw the shilling stabilize, remain quite stable. So for the second quarter, we expect as marginal, somehow marginal declines on the NFI income, but then in Q4 to remain relatively stable. But overall, for the year, we expect NFI income to contract across the industry. And then in terms of loan loss provisions across the industry, there has been a drop on loan loss provisions across the industry. And part of that is because of reduced disbursements from the banking sector. And of course, remember, loan loss, the provisions against the bad loans, of course, the first contribution comes from growth in terms of loan disbursements. So because of that reduction in disbursements, banks had to reduce their exposure. But then, of course, they have to cushion, of course, enough. They have already, most of them have cushioned enough against losses, which we shall see hereafter. And then, if you remove that loan loss provisions, generally operating expenses for banks remained relatively stable, and of course, moving up almost equal or rather double the inflation rate, which is normally an adjustment on, of course, staff costs. So we will see which is the most profitable bank, which is, of course, currently, which we shall see that on the ratios when we shall go there. So let's look at the balance sheet and how it's financed. That is the second part of that slide. During the quarter, or rather during the quarter in 20 Q1, we saw loan book, that is government securities book, expand a bit, and that was government securities book expanded a bit compared to loan book of course, banks. So why was that so? Because of low disbursements towards loans, then the banks had to cushion or rather realign themselves in terms of going aggressive on investment in government securities. And that was one reason, but the second was being because of course, to book in higher rates before they come down even more, because unless, of course, you book in when the rates are high, maybe 13, 14%, they are likely to invest at around 12%. Actually, we expect the rates maybe to stabilize at around 12%, especially in the government securities market, that is bonds market. So because of that, we saw those two reasons. We saw the banks, most of them realigned themselves on government securities compared to loans. So total assets across the industry, most of them recorded declines, with a few, of course, recording upticks because of increase in investments on government securities. So, and then we shall see how that will impact, of course, the customer deposit, how we have seen how it has impacted on interest expense, which has gone down. And then some banks, of course, have recorded declines on customer deposits and borrowings. And then we have NCBA there, Stanbic, Standard, and CoBank, which accumulates to around nine banks. So let's look at the ratios and how they performed. We have, in terms of the bank which performed the best in terms of return on investment, of course, that was Standard. Standard recorded the best in terms of return on investment. It had a net interest margin of almost 12%. Yeah, we had Standard, which recorded a relatively high net interest income, that is net interest income, and then, of course, followed by Equity Bank, followed by ABSA and the Cooperative Bank. ABSA had a net interest income of a net interest margin of around 6.5%. That is ABSA. And then we had, sorry, there is some mix up there, but then we had CoBank record around 8%. Standard was around 11, around 14%. Yeah, Standard was around 14.1%, and then followed by Absa around 12. Sorry, I've mixed it up there. But then we had the best one was Standard, and the reason for that, Standard has low financing from, in terms of borrowed funds. Standard has the lowest. If you can see borrowed funds there, Standard do not have borrowed funds. And borrowings, how, of course, borrowings come in to finance the loan book of various banks. And when you have much exposure in terms of borrowings as a bank, then of course your interest expense will be high, which will eat to your net interest income, and overall the net income, because you have to cut off that net interest expense to finance your loan book. So this was followed by Absa, as I've said, and then Cooperative Bank. But then in terms of the return on assets, the return on assets is still, Standard was the best, followed by Equity. Standard had a return on assets of around, Standard had around net interest income. I found them where they are on this presentation. It had a net interest income of 13%, and then CoBank had 8%, and then of course we had net interest margin for Absa was 10%, 10.4% on the slide shown on your presentation. And then in terms of return on assets, return on equity, and then nearly the same banks retained the same position, being of course Absa came first because KCB came number one in terms of return on equity. And the return on equity, you look at how you look at that is net income. Then of course you look at how much financing is from equity, that is shareholders funds, how much has their shareholders funds invested. So that one you look against that. And then of course net interest margins, that is NIMs. You look at, of course, the net income versus what you financed. You remove what you financed, and then you get what the net off. Then you get the outcome from there. And then, so what can we say from all these financial performance of these around 9 banks? We can say that, of course, Standard being the best in terms of a recommendation, which I will explain hereafter, and that is because it has some good profitability in terms of asset usage and how it utilizes its assets, and that part of that is reduced the cost of operation, which came in, of course, through there was a reduction in terms of operation costs, which came in because they had reduced they have gone fully digital, which attributed to that reduction. So now, overall, the profits have narrowed down of these all the banks, except a few, around 5 of them, which recorded marginal growths. Remember, like KCB recorded a growth of around 0.6%. Standard recorded a dip of around 13%. Only Cooperative Bank and Absa recorded some growths. And of course, we had also even Stanbic. Stanbic recorded a very big dip in terms of the net profits. Then cost of financing loan book, of course, it came down very fast, as we have seen on the interest expense. And then the provisions have largely come down. And when you look at the provisions, that will inform you on the cost of risk they take. That is how, in terms of the provisions you have to provide for, and that is if you write off that loan book, then you have to look at the cost of risk that you have in your loan book. So provisions have largely come down, and non-performing loans have remained very high. Actually, KCB has the largest NPL of around 19.3%. 19.3% for KCB. So that one impacted, of course, it will impact their provisions and of course their net income. And then that is followed closely by HFCK, that is Housing Finance Group. As much as Housing Finance Group looks very lucrative in terms of the future, of course, they recorded a very good profit in quarter one, which was almost equal to the first 3 quarters of 2024. So, but then their mortgage book, of course, continues to affect their financial performance. But then, in terms of the actual loan book, we can dive in and look at the loan book dispersed to maybe households and businesses. We expect that NPL to be below 9% for that. That is for HF Group. Then that is followed closely by Cooperative Bank, which has also quite a higher NPL, which is Cooperative Bank comes in closely with an NPL of around 15% on non-performing loans. So that one can tell you, of course, why is this higher NPLs across all these banks? This is because of their exposure, especially to real estate. That is number one, real estate. We have number two, the agriculture, and number two actually should come, the construction sector should come in, and of course, agriculture should come in. And part of this, the reasons why we have higher NPLs is because of pending bills, which of course from the government side, but we have seen commitment from the government, which has shown confidence of paying, or rather promised of clearing off these pending bills. We saw almost like 2 weeks ago, the government said they will pay around 229 billion against a total pending bills of around over 550 billion. So through that, if that is affected, we expect to see non-performing loans come down drastically. And then let's look at how they have performed in terms of dividend payout across all these banks. And then, of course, here, in terms of our projection for 2025, we expect the Standard to pay a dividend of at least 36 shillings and above. In 2024, they paid a dividend of, if I can show you, this is the actual dividend that they paid, that is 45 shillings per share. But then we expect this to come down because of that, the effect of the reduced, the performance has gone down a bit. So of course, their dividend payout policy is they have a dividend payout policy of 80%, which actually they have been consistent in terms of paying. So it will remain among the best dividend paying companies. That will be followed closely by KCB Bank. We expect the KCB to review their dividends upward from 3 shillings, which they paid that is last year, KCB paid 3 shillings, which has a dividend yield of 7.1% at the current price of 42%. And then that will be followed by I&M. I&M looks very, very promising in terms of growth. Remember, they have gone retail, which is the backbone, or rather, of many banks. Many banks, of course, generate their revenue from retail side. That is why you can attest to this, that even NCB has gone retail. We have Stanbic going retail. So you can see where the meat is, which they are chasing. So all that, then we have, we expect Cooperative Bank, maybe if they will review this, they should review their dividend from around 1.5. They have remained 1.5 for around 2-3 years, but their performance, their earnings per share has grown a bit. And of course, in terms of the payout rate, the dividend payout ratio, which is at around 38%, around 36%, you expect that at least to improve shareholder returns, which will maintain the price, of course, to be slightly above 15%, up to around 17%, 17 shillings per share, sorry. So this is our projections from that slide. We will share this, and then of course you'll have them. And then this is the actual, this slide is the actual dividend payout paid for 2024. Now, banks to watch, we maintain our focus on KCB trading at 41. We value the stock at around 54 shillings. And of course, because we expect them to close their disposing of NBK by end of June, is what they had said. And of course, they are expected in the long term to reduce their operation costs, especially on technology. They acquired Riverbank Solutions, which is an IT tech, which is a tech firm which will support in terms of innovations, and of course reduce exposure of sourcing outside. So KCB remains top on the list, which we give actually a buy recommendation with a price target or a price valuation of 54. Equity comes second. Equity currently trades around 42, 43 there. The price came down immediately after the book closure of 4.25 dividend per share shilling, which happened last week. That is on 23rd of May. We expect this price to stabilize at around 40 shillings, between 39 shillings and 42, which is a good entry point. And then, of course, if you can target to sell about 45 shillings, that is a good, of course, return. But then on its valuation is above 54 shillings per share. And then Standard, we recommend, of course, a buy on this. Number one, based on the dividend yield. A dividend yield is looking at the dividend which is expected, or rather the dividend paid, you divide by the price. Like now, the dividend for Standard, they paid 45 shillings. If you divide by 268 shillings per share, you'll get a dividend yield of 16.7. So that is how we get a dividend yield. And then Stanbic, trading at around, of course, 150, we expect this stock to move up to around above 180 shillings. And this will be largely driven by dividend payout. In last year, they paid a dividend of around 19.54 shillings per share, which was quite good. Actually, we value the stock above, it should be around above 180 shillings per share. So that is all from the banking sector. I think I've taken some more time. We can open this maybe. Let me hand over to you, Steve. Maybe you can give direction. Thank you.
Oh, that's very detailed. I personally enjoyed seeing those valuations and those payouts from your analysis, and thank you very much, Shadrack. As you're speaking, there was something that I thought maybe for the purposes of our audience you would expound further on. You talked about something: return on investments, return on assets, and I think return on equity. Maybe you could just, for the layman, explain it in the simplest way possible. Why is it important when I'm looking at a bank to look at its return on equity, to look at its return on assets or its return on investments?
Okay, here actually return on assets, you look at net income versus the assets that it has. Like now, if you look at Cooperative Bank, it's among the few. Of course, Standard is number one, as I said. If you divide how much you have been given to finance your loan book, so is how you have utilized your assets, the assets that you get. Of course, this one can come in from maybe the shareholders' funds. You add some, of course, some deposits there, and some customer finance, of course, some income from some financings from other sources. But purely return on assets is how you utilize your assets to get returns. And the return on equity is how you utilize shareholders' funds, because shareholders' funds is largely what the shareholders have invested in that company, and what return are you giving them? Now we are looking specifically as a shareholder. If you invest maybe 10 shillings, 100 shillings, how much is you give somebody 100 shillings? How much is he going to give you? Now that one will be return on equity. But then we look at how we calculate this. If you can see on that presentation, we have calculated in terms of return on average assets. So we look at the assets were not given immediately at the point of reporting, but then you had the assets as at Q4. You already had some of those assets, or rather, some of the loan book. You already had it, so we have to, of course, sum them together. So return on investment. It's good to look at how much you have invested, you as an investor, and how much you are getting back. So purely is like you buy nyanya and they sell, how much will you get from there? So purely that is how we look at it for purposes of safeguarding, or rather informing our clients to see the best investment options.
So is it fair to say the return on investments is basically the return I'm getting for my money? Return on assets is like the efficiency, and it's how efficient a bank is. Return on assets.
Yeah, return on assets is how efficient a bank utilizes its assets to generate income.
Return on equity?
Return on equity is how, of course, now how efficient it is now to utilize the specific money that they have been given by the shareholders. Yeah.
And then return on investments is how much I'm getting for the money I gave them.
Exactly.
Okay, that I think that's simple enough. There's this whole issue of non-performing loans, and even from your presentation, KCB just can't seem to shake off the NPLs. What gives? I don't know if as an investor, considering it's part of your recommendations, I should be worried that it's the highest in NPLs, almost double what even the second top bank equity is. And what do you think? Is it something to worry about, or based on the size of the company, it is something that they can manage?
Based on how they have explained out in terms of how they are doing the recovery, and how on the specific books which are giving them some headache, of course, I said the real estate remains number one. And part of the strategy that they have, of course, engaged the government on specifically the contractors, the contractors of either roads, and also, of course, I expect the current housing maybe to be there. Am I still there?
Yes.
Okay. Okay. So the first strategy they are putting, of course, number one is to provide enough provisions, which is provisions in two ways. They have provided almost over 50% of the loan book. And then there is collateral provisions, which comes in from, of course, when you take a loan, you give some collaterals to act as some backup. That is as a security for that loan. So of course, you can't go and sell that security, or rather, that is an extreme measure that can be taken. But looking at how they have provided that for that book, which is almost at 50% and 50, almost between 40%, 60% provisions, 50, either 50, 60, okay, between 40 to around 60% provision of the book is already covered, purely covered. Now, number two, they have gone ahead to engage, of course, the government, and I perceive that there might be some of the reasons why the government has also focused on pending bills might be some pressure which comes in from, of course, across the quarters. So part of these the pending bills that have been promised to be cleared, of course, 229 should be cleared before the end of the financial year, which ends in June this year. So that, of course, will have to go to reduce part of these NPLs. Remember, these three sectors contribute almost 30%, let's say above 25% of the NPL. So if part of these pending bills has been paid, which is almost a third of the entire pending bills, so that will improve their NPLs. Number three, we have, of course, we are seeing the economy recover a bit, and we expect businesses to perform at least somehow better compared to when the rates were very high. So there are options of restructuring these loans. And also, as you restructure, you're giving room for your customers to repay back, of course, at reduced amounts. So those three measures, for me, I feel comfortable how aggressive they are. Of course, they have gone aggressive in terms of now corrections, which of course involves, of course, their staff and various measures in terms of correction. So purely, those are around 4 measures, which is comfortable actually. And then if you look at the provisions are quite well in terms of the loans are well covered.
Oh, so you're saying they have already provisioned for this serious possible defaults. So we should not really be worried that their eventuality would cause a significant hit on their profits. Question again now, still on the banking before we move to Safaricom as we close. There is this counter Stanchart, which has very very attractive dividends. However, I don't know if I'm not reading it well, because I perceive that Stanchart also does not have serious regional expansion plans. Neither does it have is its book or is its assets growing as fast as we would see the ones like NCBA and Stanchart and not Stanchart, NCBA, KCB and Equity. I don't know what your thoughts are, especially if I am investing for a dividend counter. Should I pivot to NCBA or another counter that has both potential to be a good dividend payer? Because NCBA paying 4.5 shillings is I think 5 shillings is still quite solid. I don't know, just something to, because every time we talk to investors, there's always this bit, Stanchart should be in your books. But I'm thinking, if Stanchart is not growing, what am I just locking in money for the next 5-10 years? This is just me speaking. I'm not I'm not giving any advice, but I'm just picking your brain about that counter.
Now, looking specifically on Stanchart and the model of growth, they are focused, of course, local market with no, of course, no, in terms of growth, they have not given any other, how they may be regional expansion. But then I'll ask you to look at also Cooperative Bank and how their profits have been quite consistent, and they are largely local because they have, I think only one subsidiary, which is South Sudan, most of it which is sometimes underperforms. So looking at that, and then the local market has greater potential for growth, and then that is why actually this, whatever you call the NCBA, you say, and also I&M, and I will add Stanbic to that list. So looking at the model of how they have grown for the last below 2 years, how they are growing right now, if you go to any town, these 3 banks have set branches. Of course, their presence there. So that can inform you that the local market still has greater potential for growth. Either has not hit the optimum in terms of banking, or rather banking returns. So for me, I actually, and also looking at how they are efficient in terms of their online, they are quite digitally. They are among the first banks which went digital, that is Stanchart. And also that digital, they have maintained some good income across for the last, I can say, like 3 years, for the last 3 years. And then last year performed extraordinary, very well compared to other years. That is when they, of course, they gave a dividend of 45 shillings from around 29 shillings the year before. So that informs you, of course, their potential in terms of growth. And then as much as this year, we are seeing some declines overall, a decline of around, even if it's around 10% decline, still Stanchart remains at a very good profitability. That is why in our forecast, we reduced the dividend payout, the dividend from around 45 shillings to 30%, to 30 shillings per share. So still, if you calculate within that dividend, Stanchart gives a very good return compared to the others. I don't know whether I've answered that.
Yeah, you have, and even as we come to a close, maybe you can start sharing your video. But there are two questions that are very good from our audience. Dickens is asking, what is the current share price of Safaricom? I would point you to the Dosika app link that I've just shared, because the Dosika app will give you share price for not only Safaricom but also all the counters, as well as the order book. The order book is information about how many people are bidding or how many people are selling a counter. So try out the Dosika app. But Jean has been very kind to share with you the price, which is 20.65. But a good question from Muriki that I think would be something to end with. There is this article that came out the other day that Safaricom is part of the government's plan to divest on its entities, which was 148 billion. I think the reporting was, in my view, a bit sensational, because 148 billion is not what they plan to sell Safaricom for. It is their total divestiture for this financial year at least. And Safaricom, of course, would make quite a significant chunk of that. But at the current pricing or value of Safaricom, I suspect it is more than 148 billion. But I would like you to just speak to Muriki and other investors who are probably thinking, should I really buy Safaricom if government is selling its stake? So can you kindly just maybe in 2 minutes or one share your thoughts on this news article?
Number one, I look at how the divestiture, or rather how the sell-off will happen. Definitely do not be on the free float, or rather maybe the open market. What I expect to be a prudent investor, it should be maybe through strategic investment, which will definitely cushion against price erosion. So I don't expect the government to, of course, offload in the larger market, just like maybe, and then if that one comes, then it will be through maybe an IPO. But then what I'm foreseeing should be through private, or rather through a PPA, private partnership. And then, of course, it's not a good move in terms of disposing of this stock, because it's likely to impact its share price downward if not managed very well. So number one, I'll say it's not a good move, of course, for the government, because that is not the best way to finance your operations. Of course, you get dividends which are very good, of course, every year. So, and we expect, of course, Safaricom to increase their dividend, especially as from 2026 onward, which will be a very good return to the government. But in the event that they dispose it, two things are likely to happen, which is the price erosion, if not handled very well, or there will be foreign inflows, which is likely, of course, to stabilize the price. And of course, in terms of corporate governance, that will bring in some more, I can say, some stricter corporate governance on the stock, which will, of course, result to improved returns. So it will depend purely on how the government plans to dispose it off. That will tell the next move, the next course of action. But for now, the valuation for Safaricom remains very good. And looking at Ethiopia, counting on Ethiopia, and also even the local market, even if we exclude Ethiopia, local market Safaricom remains very lucrative. Thank you.
Thank you, Shadrack. And I agree with you on that. It will matter how they dispose of it. And I am of the view that it will not be negative for investors, because if government really is in need of money and is trying to use Safaricom to sell its shareholding in Safaricom, I would not imagine that if Safaricom is trading at probably 20.65, as has been shared by Jean, that Safaricom would say would agree for an offer that is less than that. So, like you said, these transactions or these deals usually happen over, I don't want to call them over the counter, but they're usually arranged transactions. So you'll find that maybe Vodafone wants to increase its share, is maybe asked by government if it can increase its shareholding. So what will happen? It will just be shares changing hands, as opposed to, like you've said, it being offloaded in the open market. And in my view, that's why I foresee the share price not being affected negatively, because I imagine this is going to take the format that all other counter big bulk transactions have taken. Like if you remember how Stanbic also bought additional shares, usually it's a strategic partner, a strategic investor that comes and they buy a huge chunk of that share. What happened the other day with Diageo and the ABL. So there will be some form of transaction, but it will not be like we see one day 50 billion worth of shares is offloaded in a single event. So I would say keep an eye on it, but what Shadrack and his team have given, I foresee that in the long term, Safaricom will still be a solid counter. Remember, it still is the most profitable company in East and Central Africa. So something to consider. I don't know if you have any parting shots. You can share your. We shall share this presentation, and it shall contain contacts for the team for Pergamon, and of course, please again try out the Dosika app. I'm sure you'll enjoy your experience, and feel free to share your feedback on how the app is and what we can do to improve it. But other than that, Shadrack, maybe you have any final thoughts before we close?
Yeah, we have shared our numbers, our contacts are on the screen. You can, of course, reach us through any of those. But then your investment is very safe with us on this end. And then, of course, we are looking out to more discussions like this, more advisory. You can go to our website. We are launching our new website, which will be, I believe it will be among the best in the country. So, and then our resources, they will be among the, I think they are rated among the best. So, of course, as much as we might be not very old in the market, but we can assure you that your investment is in safe hands. And also the advisory we give is in-depth, as you might have seen from this presentation. And then my parting shot will be, maybe before I say my parting shot, I don't know if we have Purity on the line. My colleague Purity, if you are on the line, you can maybe say a word. All right. Anyway, we are so grateful. Thank you, Stephen, for partnering with us. We expect more discussions in the future, and we look forward to invest with you and also maybe discuss with those who are in the meeting for more investment options that is available. We assure you that we'll give you nothing but the best. And also the principle I will give you is buy low and sell high. Thank you.
And if you don't know when is it high, or when is it the right time to buy or sell, that's why you have financial advisors and investment banks such as Pergamon. And always, if you're not sure, please consult your experts. Thank you very much, Shadrack. Another something that I also like sharing with our audience is the same way you invest in money market fund, the same way you accumulate your real estate, the same way you invest in, or you pay your insurance premiums, is the same way you have to approach stock market investment. Don't be those folks who bought Safaricom at the IPO and waited and still wondering how did Safaricom move from 5 bob to 20 shillings, or people who still hold securities in certificate format. So please embrace that habit or that discipline of buying a counter. It could be Safaricom, it could be KCB, it could be any. You can decide to spend maybe 3,000 or 5,000, whatever amount you are able to on a monthly basis. And sure enough, that is how compounding works. And you shall, when we are talking about 5 shillings, or when Safaricom moves from paying 1.2 shillings to 3 shillings, it will be a very different conversation for you and your finances. Thank you very much. Again, download the Dosika app. For those of you asking for the presentations, we make it a habit that if you stay till the end, we shall share with you the presentation. So everyone here in this session will get the presentation as well as the recording when it's done. And you can follow us on our YouTube and other social media channels at CDSC Kenya. And thank you very much for taking time to be with us, and hopefully you have learned something that will inform your investment. Have a lovely night, have a lovely evening, have a good morning from wherever you're tuning from. Bye.
Bye. Thank you.